All right, this is Jeffrey Scott. Welcome. It's 4:33 on February 9th, 2014, and welcome to this week's HGSI top-down review and market study. Get everything set here. What a week. I guess it was a tale of two cities for me. I've entitled today's talk as Trend Reversal or Bull Trap. Let's fix this. There we go. And, it felt great on Thursday and Friday. There are some kinks in the armor, and we'll talk about those. Ron Brown did an outstanding review of the S&P 500. I share most of his thoughts, although you'll probably see a little bit of a different when I do my analysis, it'll be a little bit different. I look a bit more to the downside risk. As most of you know, just to review, make sure let's get this thing back here. This is for education purposes only. Anything recommended in the spirit of education, not investment advice. I'm a doctor, not a broker, and I'm not affiliated with any software vendor or trading company. Anything I demonstrate, I pay for myself. I do this because I enjoy doing it. I like to teach. I also do this because it forces me to follow a routine. The intent today is not to tell you what stocks to buy, but to show you how I use my favorite programs with a lot of concentration on HGSI, of how I find, either both how I look at the market, what are the sectors that are working, and also how I identify stocks that I might be interested in purchasing. No guarantee that I'm going to buy what I say I'm going to buy, sell what I'm going to say I sell. This is for purely education. It's that time. You need to sign up for the HGSI workshop with Ian and Ron. Both George Lee and I will be speaking there. Often we get other guests like Gil Morales, Fred Richards, so it's really a great show. This will be a little bit different as Ron and I will be in. Hopefully George as well, with Ian sprinkled on top. We'll be doing some live in the market trading on Monday, so we're going to put more of a focus on trading on Monday than we have in the past. Go to the website for information, $12.75. It's a bargain. It'll be a lot of fun. My meeting, as everybody knows, is sold out. I will probably do another meeting in between the two HGSI service meetings. Haven't decided when and where. I'll talk with George about that. We had sort of a shockingly strong interest. If you are coming to the meeting, you will receive an email later that will have a link to a Dropbox. In that Dropbox, I will be putting some of the information that you'll need to have with you when you come to the meeting in New York, as well as the basic slide decks from George and from myself. I always go to this PowerPoint because to me it's a great PowerPoint slide in that it really shows you who I've learned from. And you have to become your own guru, and whether it's O'Neill, Morales and Catcher, Alexander Elder, Pascal Willane, Bigelow, Minervini, Van Tharp, Colling, Gronke, these are some of the people that I've used, some of the websites. I found that the best way for me to learn how to trade was to go to education programs, participate in various trading rooms to learn styles, read books, and then take what I thought was the best of each of them, come together in a way that made sense to me, and that's how I trade. I have a lot of different programs. I specifically use on a daily basis a real-time platform, whether it's Thinkorswim or TradeStation. Typically, it's both. I use HGSI Aftermarket. Can't wait for George Roberts, who's a proprietor of HGSI. I can't wait for it to get real-time data, in which case I'll have to reevaluate. But HGSI is my end-of-market analysis tool. I use EdgeRater for a number of different things, as you'll see as we go through. And EdgeRater's data is fed by HGSI directly. I do like seasonality with Magenta, and from time to time in these videos, tonight I'll throw out what I think is a super strong seasonal play. And then I also use MarketSmith for additional fundamental data on some of their scans. Where are we? I feel like a broken record. Last week I said we were rolling over, and the question was, would we bounce and go to new highs, or will we continue down in stage 4, fear and discounting of the market? And lo and behold, on Monday and Tuesday, I thought we were getting down there. And then Wednesday, we had a reversal, and Thursday and Friday, we were back up. I don't think we're necessarily out of the woods yet, we'll talk about, but clearly we are back up here on stage 3, and potentially we heading back into stage 2 on an uptrend, which has been the pattern. Last week, I thought the market was overbought from a long-term perspective, but oversold short-term. I thought you could be bullish in some ways, but concerned about Fed continuing to remove QE, which will pressure on emerging economies, rising dollar, but interest rates would be stable, which would be good. And despite the concerns of the market, what made me somewhat bullish was the LLURs and Canaries seem to be pointing to the upside. I also noticed last week that the interest rate sensitive groups, home builders, REITs, MLPs, utilities, seem to have stabilized. And if you remember last week, there were very few positive groups, and the most negative group on force was biotech. This week, as I said, we had a reversal hammer signal on Wednesday, almost kind of like a hammer. However, the rally on Thursday and Friday were lower volume. We need to get above the double top quickly at 1850, or we may have something that looks like head and shoulders or a triple top. We could see resistance at the 50, which we'll look at, and then turn down towards the 200 at EMA, and this could turn out to be a bull trap. From industry groups, the stable interest rate groups seem to continue to do well, but boy, was there a resurgence in biotech this week, especially on Friday, and silver miners perhaps starting to stir. Canaries, a list of market leaders over the last year. You can see the strong performance of the group from clearly at least a double in the last 10 months. Stocks are listed here, and we use this this is a true market leaders index, and it's a little narrow, but when it rolls over, it will tell me that it's time to get out of the market, and it's breaking out to new highs. Everything green on the momentum indicator. We're squeezing. A couple of mobile breakouts last week in the squeeze, and it took off. The LLURs, which is a much broader index that we created in October, looked like it was about to give up the ship, but it held at the 50-day moving average like it's held in the 50-day moving average in the past, and held at the 50-day moving average, and now it too looks like it's going up, coming out of the squeeze. Momentum indicators look strong and had a good move on Friday. So my leading market indicators point up, which is nice to see. Now on to the charts. So one of the first things I'd like to do is I'd like to quickly go look at TradeStation and look at some of the elder indicators of what the market's doing. Before I do that, let me point out on my radar station, on the stocks that I'm looking at and that I own, I have the earnings painted automatically. If you don't have the earnings out, these are some of the stocks I was looking at buying. Over the weekend, it takes sometimes a little time to fill these in, so they're going through and pulling them automatically. There are free indicators on the web and TradeStation. There is a column in HGSI. It's available now as well in Thinkorswim. You got to know when your earnings are, because if you don't know, you will get burned, and you'll be playing, as Gil Morales calls it, earnings roulette. So I'm always looking at what's coming in the next couple of days, and I find that unfortunately these things are not perfect. I think TripAdvisor may have already had their earnings, or maybe they're up because of Expedia. But it's really important that you know, if you don't have this indicator, it's available free. It no longer is tied to briefing.com. So if you email me, I will be happy to send you a link to download the indicator for Thinkorswim, for TradeStation, and it is at no cost. So I like to quickly look at the elder impulse indicators. So I'm going to look at very quickly just the big three. We'll start with the NASDAQ. Obviously, all were up over 1% on Friday. Some were up about that much on Thursday as well. And you can see we've gone from red. We talked about it. You get below the lower envelope, eventually you're going to bounce back up. Thursday we turned blue. Friday we turned green, back up to at least into the middle of the range, blue on the weekly and the monthly. You know, the MACD pulled deeper down than the prior MACD, so leading the price down. No divergence there. It'd be interesting to see if we can even break the back of the MACD as we come back up and test the old high. I'll be looking to see if we can't get above that old high before I want to make a call that we're out of the woods. If I look at the Dow Jones Industrials, similar pattern, broke under blue for several days last week, green on Friday, breaking back into the middle range. Interestingly, the Dow, which has been some of the weaker of the indices, is still showing red on weekly, and again, deep on the MACD histogram, pulling the price down. And then lastly, the S&P 500, it too went green on Friday, blue on the weekly, and the daily and the monthly. So the elder indicators, by being green, are telling me that I have the ability to go long if I like. By being blue, I can do pretty much whatever I want. I don't usually go short when they're red, and I don't go, should be short when they're green, nor do I go long when they're red. I look for a reversal of that color. So that's a little bit better from a market perspective. Now, last week was a tale of two markets. Here's from the open on Monday to the close on Friday. So the first thing is, despite the fact that I said it was a tale of two markets, I'm going to clean this up a little bit. I thought I already did that. My apologies. Delete that, and I'm going to paint that one black. As you can see, for me, it was a really flat week. Horrible Monday, Tuesday, and great Thursday, Friday. This is based upon the things that were in my portfolio on Friday last week. Doesn't mean they're in my portfolio now. We could see that some of my momentum plays, Kahuna Force, Mobile Breakup, Pocket Pivot, Bible Gap Up, I call that a pentaplay on my scans. 16 of them, this was done on Friday. We've been, whoops. You know what? Ignore this. I ran this on the wrong dates. Let's go back here and look at this one. These are the right dates. Yep, this is looking at the prior week. You can see black, more red than black over the last week, so it was a tough market. The S&P 500 actually ended up finishing up 0.81%. The IBD 50 was below 0.57. HGS 100 was below that. So it was not a great week for growth stocks. The big winners were MarketSmith 250 growth was up 1.62%, but less than 50% of the stocks were positive. The stocks that were daily and weekly Bondo, yes. Again, less than 50% positive, but up 0.8% for the week. So really not a great week for my growth stock long scans. So again, a tale of 2 weeks, with Monday and Tuesday being very weak, Thursday, Friday strong. The Hindenburg did not fire, which is good to see. We've seen hopefully the new highs here bottom and start to go up, and the new lows starting to head back down. We did not trigger a Hindenburg with this. Bucketology, still the majority of stocks in the S&P 1500 are below the midline of their Bollinger Bands, which is a bearish sentiment. But as I'll show you, this number's actually come up some. And to me, it's a trend that matters. Now I see that the majority of the stocks here, as you'd expect, are below the midline, but there are very few stocks above or below. I looked for extremes last week on Monday night. This was an extreme. 45% of the stocks were at the lower Bollinger Band or below the S&P 1500. So I clearly expected a recovery, although it took a day and a half longer than I thought. From a market perspective, we look at the percent beat times bandwidth, sort of the Woody indicator. Red is bad, green is good, and perhaps we're seeing the end of the red, where we had some green poke in this week, as well as a kahuna. So these are just a number of different markets, which they are irrelevant. It's more about the story of the ebb and flow of the market, and this makes me feel a little bit better that going forward we might be looking up, but we'll see. If not, it could be a fakie, as Ian likes to call it. We'll come back to that later. These scans, the Hindi, the bucketology, the market analysis, are all done using EdgeRater, which automates a process that used to take me hours, and now it's something that I can get done in a relatively short period of time. So it's one of the reasons why I'm so enamored with EdgeRater. Is just makes my life easier. What else do I want to look at here? Go back. Let's go into HGSI itself, and let's take a look at the market from a little bit different perspective. First thing I want to do, unfortunately, I have to change my screen for this, so I have to resize it when I come into it, is go down into the designer, and I will look for Ron Ian's user groups here, and Major Markets Plus. I'm going to take off my filter. In fact, let me just do this outside the designer. Let me just do it from here. We go to a T1, top-down analysis force and bongo scorecard. And what T1 does, it looks at more than just the last couple of days. It looks at 1 day, 5 days. It's all price and volume. It's got some force indexes in it. It's heavier weighted towards right now than 2 or 3 weeks ago, but it's not just a 1 day performance metric. And let me apply it to Major Markets Plus, and we could see that using this combo rank, the strength flip-flop from last week. Last week, dollar and volatility and T-bills were at the top, and this week we've had a resurgence in the market with NYC Composite and NASDAQ up at the top. Gold and silver should be somewhere. If silver's down here, although the miners started stirring, we'll look at that later. The rest of the indices sort of middling here. I look at a 5-day performance. Silver was up 4.4. There's my comment about the silver miners. The Russell 2000 was down 1.3. Volatility ran up and then crashed, down 16.9% over the last 5 days. Small stocks is by small cap 600. Russell 2000 underperformed the major indices. As I've already showed you, the S&P was up a teeny bit. When I started looking at the market for this, and let me get this thing. Last week I tried to leave my, all right, not cooperating. I wanted to leave my resolution at full resolution. I thought that would make my life easier, but it took me forever to upload it onto YouTube because the file size was so big and right downloaded. That's what I'm talking about. So I brought it down to HD instead of 3 HD that I had last time. So here's the, I've done in the past. Let me go into a simple chart view. Okay. So let me go down to, all right. So here is a view of the S&P 500. And I've shown this index, repeatedly talked about a low that we saw in the market that came in the middle of November. We had a nice green candle low here. And if you had bought on that day and are still holding, well, the max you would have gotten at the high, you would have seen a 46% increase, which is a pretty darn good 14-month period of time. We are still up at the close on Friday, 42%. So this has been a huge market run. Now, this run has not been nonstop. A lot of press have talked about the lack of a big correction. We've seen a number. Here was 4.6% among friends. Here was 5.3%. Here was the biggest one, which was a 9% last summer. 6.4. Make sure I got this right. 8.8%. Yep. Excuse me. You kill my email. That might be a good idea. All right. So 8.8 was the big one. We've had a number of ones that have been around 5%. The sizing thing is going to kill me. I need to. So 6% there. So what do we see here? This big one that the press basically made me feel like my world was over, down 6.9%. So well, depending on what you look at, 5, 6, 7% is the correction that we saw. So on one hand, one could strongly argue, hey, this market's intact. We've had a series of pullbacks. Others could argue we need the 8 to 10% pullback and a correction. And so the question is, are we going to come back down, or are we going to go back and take out some highs? Now I'm going to kill the volume, but before I kill the volume, you can see the down days, by and large, have had much bigger volume than the up days. So this is a low volume recovery, and that perhaps takes a little bit of the luster off of it. Go back into this view here. About 1850, we sort of have a double top in here. Okay. And I'm not such a fancy technician. I don't know how many days apart you have to have. But we stalled at this point twice. We pulled down essentially to this ascending trend line, connecting to the lowest low before the most recent high. We stopped with a little porosity right about there. Now, do we trade back up and take out this to a new high? Well, that would be what the market has been doing, and that would be nice to see if we can do that. That's the bull case. Do we fail at this 50 and then come back down and test perhaps this level of support here, which would correspond to the high from this up thrust, and sometimes the resistance turns into support? Do we pull back even deeper to a rising 200-day moving average? And I think that this is really still a question mark. My gut feeling is we're going to go back up to new highs. But if we reverse at the 50, if we reverse before I get to the 1850 level, my gut is meaningless, and I'm going to be worried more about protecting some of my profits. So that's my thoughts on the market, and I welcome your comments. Since this is not live, you can always respond to me. I like to look at the various market components. So we've been looking at the S&P 500. Let's just go back into it. Let me go back to my typical view. I'm now using the toilet bowl, which you'll get soon enough. The toilet bowl adds things that you don't have yet. So I got my 200-day simple, 50-day simple in blue, and in green my 17-day simple. The magenta is my 8-day exponential. I like to buy when things break above and sell when they stay below. I've got my Bollinger Bands, which show the squeeze back here. I've got my volume on the lower bars, although there's no volume on the straight S&P 500. On the lowest ones, I have impulse indicators on whatever I'm looking at in my charts. These are kahunas. Blue is good, red is bad. The darker they are, the more impressive they are. On this bar here, I have what's called Eureka's in green and Phoenix's in red. They're only calculated in the NYSE, and they are indicators that would suggest exuberance in the market. or our turnaround day, so to speak. There's a lot of mess here. Green is good, red is bad. We have bongos, which are momentum indicators that we built in HGSI, trying to find ways of predicting as a market timing. We have accumulation distribution. I have short and long-term force, just like I have short and longer-term bongos, the daily here, the weekly on the bongos there. The 2-day force, and then on top of the 2-day force is the 13-day force. Since there's no volume, you don't get force. This is the high jump bar. When it gets to be the highest point, it's usually when you see turndowns in the market. The green and red reflect green candle lows and red candle highs. This is a DMI, and I'll paint crossovers on stocks. This bar here is viable gap ups. The next bar you don't have yet, which is called squeeze. And these are mobile breakouts. And you'll be getting an invite from George sometime at the end of the week. I think Friday I'm going to do I think it's even live in the market, of how I use mobile breakouts, breakdowns, and squeeze. If you come to my live meeting, you'll be broken out enough with how we talk about it. So looking at the S&P 500 with my routine chart, let's tighten it up a little bit. I don't need as much. I see this pullback. Here's that pseudo hammer formation. Big day. Friday got above that 8-day exponential. I have some resistance to be concerned about right here. And we'll see if we can carry through the upside. And again, what happens when we reach these old highs. As we pointed out, volume was low. NYC composite, a bunch of pocket pivots down with a pretty substantial fall here. It got right down to right above the 200-day moving average, which would be a natural place to expect a reversal. It reversed, got above the 8-day. Mobile breakout on Friday, starting to turn green on momentum indicators, getting close to cross on my DMI crossover. So again, like the S&P 500, looks like it wants to reverse. Still got resistance at that 50. I want to look at the Dow Jones, 30 stocks that make a big difference, at least from a emotion perspective. As we saw in TradeStation, the Dow actually corrected more than the others. Again, getting to that perfect bounce place with a close right below the 200 on Monday, at the 200 on Tuesday, a hammer at the 200. Starting to look to me here like the 200 could have turned into be some resistance. And then the exuberance of Wednesday and then Thursday, despite negative employment numbers, getting above the 8-day, again, looking like a nice reversal. We are not out of the woods yet. And as much as I want to be bullish, this 50-day moving average may turn out to be a little bit difficult to get through. We'll see this week. Russell 2000, one of the weaker ones as well. Although it didn't travel down to the 200, it too bounced, got above its 8-day as well. All momentum indicators red. So to me, the indexes look the same. They pull back to support. And we'll see if they can't get through short-term resistance at the 50, and then long-term, can they take out their prior highs. Volatility, you want to sell spikes. You want to buy apathy. Excuse me, you want to buy spikes and sell apathy. What do I mean by that? When the VIX gets really low is when market corrections start, and it's when the VIX rises that the market is falling. So when the VIX is as low as it's been in quite some time, then that's a time when you might be a little bit concerned that you may have some potential correction coming. When the VIX gets high and it stops going higher and starts to fall, that's when you get the big market rallies. So I always grew up feeling that a low VIX is good, and it is. As long as it stays there, a low VIX would imply a market that's strong. But when that VIX starts to rise is when the market gets painful. If you think about after the first couple of days of January, we've been in a rising VIX. Well, you could see the VIX got hammered on Thursday and Friday. Still has a ways to go to get back to where it was in more complacent times. But that falling VIX certainly led to a nice rally in the stock market. Now, no shocker here. The VIX corrects in about the same place every time. So in fact, it almost was the exact same high from October. So VIX is down. It would be important to watch it. If you play leveraged instruments to the VIX, then you had an interesting week. Made some money early and then hopefully got rid of them as the week went on. So the VIX whacked down. I look at the dollar. The dollar continues to struggle. And, if this was a stock, you wouldn't be buying this stock. You can't get, it's stalling at the 50, has to get above the 200, hasn't been above that 200 in quite some time, going back to September. So even though you start to hear strength in the dollar compared to the rest of the world, it's really not showing a whole lot there. Interest rates have actually come down with the easing, or with the removing of the easing. So that was kind of interesting as well. We could also take a look at oil. USO popped above the 200-day moving average. Green on the momentum indicators. Had a Mobo breakout, but not from a squeeze on Thursday. It might be interesting to see if oil goes up. If oil goes up, then you might have to wonder about things that are dependent on oil, like airlines, which that could cause some pressure on airlines. It also could cause the oil exploration stocks to start to wake up. They've been sleeping. Gold, same old, but maybe trending a little higher. It's holding above the 50, which was one of the first steps that I had to see gold do before I could get interested. Now I worry about can it go much higher because of that 200-day moving average. And then silver looks a lot like gold, except silver's better than it was. It's actually now broken above the 50, and that had been a challenge. So tested it on Friday and closed up for the day with a bullish engulfing pattern. As I said, gold looks like it might be, silver looks like it might be stirring. So that's gold, silver, and the major indices. Out of curiosity, I want to go to where I have volumes and look at S&P 1500 here. I'll put it up as a chart. The 1500 includes the 400 mid caps, 600 small caps, and 500 large caps. So it gives you a nice overview of the entire market. But what we use it for are Ron and Ian's famous eye charts. So what I like to look at is let's look at accumulation distribution. What I want to see are the A's and B's, or at least the A's going up and the E's going down. And that's starting to happen here, but you can see in the weakness that we had, the A's really bottom. So you can see the A's and the B's turning up, the E's turning down, D's leading. So when you have mostly accumulation D, you've got a tough market. Another thing I like to look at here is the percentage of an index above their 20-day, 30-day, 50, and 200-day, kind of as we look at the buckets. So one would expect, because of the buckets, that the majority of stocks be below their 50. They are. Last week I pointed out that we were getting to the point where the depth of these indices below their moving averages were getting to the points that we haven't seen going back for a while, and that might be evidence that we can do a reversal. And we've seen it, and you can see the percent index above their moving average are getting closer to their moving average in the short term, the first. So perhaps we've still got more evidence of an improving marketplace. I also like to look at 5-to-1 and 10-to-1 days, which are big wake-up days. And you can see that on Friday we had one of those. And that you get these big wake-up days when you have a 5-to-1. It's a 5-to-1 chart where in this case, the daily advance decline volume advances versus decliners. Advances were greater than 5-to-1 times decliners. So that's a bullish signal as well. So next I want to go look at industries as part of my top-down review. Now, there's 145 industries, and was there 10 last time? There were so few, just a handful of positive indexes. And as I pointed out last time, biotech was one of the worst performers. So a lot of people wonder why I switch views around, so let me show you why. When I'm looking at a stock to buy, I want stocks that have been in an uptrend. I want stocks that have pulled back typically and give me a momentum sign to go up. So I use either the T1 or a typical scorecard that's a balanced technical and fundamental that gives me more than just a couple of days. So when I'm prospecting for stocks, I might be looking at to find things that actually have been in a trend and not a one-day wonder. When I look at sectors, it's important to me to know what's moving right now. I'm a top-down guy, which means the first thing I do is figure out if the market tells me in or out. This market still worries me, but it's more towards in than it was last week. Then I want to see what industry groups are leading, and then what are the best stocks in those industry groups. So I need to know when I say industry groups are leading, I don't care what they were doing 3 weeks ago. I care what they were doing the last couple of days. Now, I'm playing with some other ranking modules here, because one problem with the module that I use, which is a 2-day force, is it puts too much weight on volume. And although volume is incredibly important, to me it should be the volume delta between the average volume and the current day's volume. And so stocks like Bank of America and JP Morgan, stocks that have massive volume always end up at the top of the list. The positive list if they traded up and the negative list if they traded down. So we start with 145. Why do I like that? What was the best group this week, at least on Thursday and Friday? It was biotech. But biotech is showing as the 26th group. So I need something that's much faster. So I'll take that 145 and I'm going to separate them into bad and good. On the bad, force index down, there's only 2 this week. Managed care, no surprise, every day you get another major payer saying that they're not making the money they expected to make on the exchanges. Well, that's not a surprise because they're going to make the money on the young folks, not the old folks, and the young folks aren't signing up. Food retail, I don't know much about that group, also down for the week a little bit, but almost 4% down on the managed care index. If I look at what was up, we went from a handful to 97. So short-term up, most of the index groups, you can see that the 2-day, which is what we're ranking upon, this is an exponential average of the last of a 2-day force, and so if it's a 2-day exponential average of the force index. So it's really only looking at 3 different days. The 13-day is looking at 15, 16 days worth of price and volume. You could see that most of these have red for the 13-day, which means they're in a longer-term downtrend. So they pulled back and they popped up. So let's go through the top 10 and see if we can't find any through prospecting stocks that we might be interested in taking a look at. I forgot to look at the clock when we started, but I always take an hour and 5 minutes. Biotech, I right-click on it, and I see some really interesting stocks. I hope you own some biotech. If you listen to me enough, you better, because I'm always talking about them. Sometimes they work. When they work really nicely. And when they don't work, they get clobbered. This will be a good start. Intercept Pharmaceuticals, I came out with a relatively bearish story on it, and now I'm going to change my story a little bit. Change is the wrong word. Now I'm going to advance my story a little bit. When it first came out, this is danger. And I came out, I think I came out on this day. This was Friday, and I believe this was Monday. Let's see, the 13th and the 10th. And over the weekend, I said, this stock reminds me of some others that have done poorly, and you've got to be very careful chasing the stock. Market pulled back. Why am I a little bit changing? Because I've got a stock that's now giving me a new base. You can see the Bollinger Bands are starting to come back together. I had a mobile breakout. Everything is green in the kahuna on big volume on Friday. If this was a $34 stock, I probably would be a lot less scared than a $340 stock. But if you want to play Intercept, and you want to be long Intercept, the day to get in was Thursday. Of course it was, but you may not have seen it until Friday morning when it showed strength. So Intercept is on my, I call it a special situation. I'm going to watch it. I'm probably not going to play it. It's a little bit too dangerous for me. But I've gotten over this $400 range, and it's had a chance to work out its price, and maybe this is going to be the new norm. Ariad. This is a stock that used to be over a $20 stock that got hammered when the drug came off the market, which is not a good thing for a drug company. Quickly went back on the market. It's been in a slow uptrend up. As a cancer specialist who no longer treats patients and has no inside information on the drug, I can tell you that my friends and colleagues love their drug, and they went through hoops and ladders, and chutes and ladders to get access to the drug after the FDA took it off the market, which is very bullish. Looks like it's starting to break out again down here. Big kahuna, volume coming into the stock. Mobile breakout from the squeeze on Friday. Everything is green. The drivers on this stock are potential earnings, the fact that potential buyout, and number three, they've got a little pipeline. It would be interesting to see if this can make a run up to that $12.5, $13 range, which is my target at 200-day moving average. Celgene, the drug that I've loved, a company I've loved for a long time, it's long in the tooth. There's no question about that. Went sideways until the beginning of last year at about 80, and then doubled over the year. It's had a pretty deep pullback over the last couple of weeks, enough that I got shaken out of my long-term position. I'm back in. I don't know, it's a little mini base there, kahuna on Friday. Like the market, it's going to have to get above a 200-day moving average. I'm seeing expansion in earnings going forward in MarketSmith, and they are in the oncology world a leader, cancer world, and they got a great management team. As I said, I own it, so of course I'm pumping it. Biogen IDEC, talked about this one several times in the past. I usually point it out when it's putting close to that 50-day moving average as a time to jump in. It's running again. It's certainly a leader in the orphan drug status. Had a, as you can see, a mobile breakout from the squeeze on Friday. A kahuna, everything is green. That's a very looks like it's setting up to run again. It's an expensive stock for most. Gilead is one of my favorites for this year. I like to buy these when they pull back to free parking, known as the 50-day moving average. It pulled back to the free parking on Friday and bounced off of it. In a pullback, I don't have to go in it tomorrow. I might wait till it breaks above the 8 to 17. I might wait for a kahuna or a pocket pivot. I want to see when the earnings come out, but I think I already know the earnings already are out. I listened to the earnings call. I thought the earnings were good. The market sold off anyways because they did not give enough guidance on their new hepatitis C drug. I think they're just setting up the market for a blast off. I still love the stock, and it's one that I will put in my portfolio, and I have. Alexion, I talked about it a lot, had a big breakout on earnings here, and a flag. It looks like it wants to run again as well. There are some analysts that have put $200 price tags on it. So anything else here pops up is something that you need to look at short term. I'm sure you all have your favorite biotechs. There's a lot of them out there, and they're working now. Communication equipment. It's funny. I didn't really love the Nokia chart when I looked at it, but it was up 10% in 5 days. I didn't love it because it's below the 200, starting to turn green. So it had sold off pretty hard. Maybe it's setting up now for a nice opportunity to think about it. But a kahuna, it had a mobile breakout without a squeeze on Thursday, starting to show some green on momentum indicators. Here's Cisco below the 200. I skipped right through that one. Qualcomm going sideways. A lot of green momentum indicators. makes money. The old name, 2% dividend. I don't get that excited about these old codgers. Palo Alto Networks is one that I like. This has been a nice moving stock. Let's get some more information here. Broke out with the Bible gap up on Thursday. Friday, kind of a funny looking day with long-legged, small body, and closed less than midline down the Bible gap up day. Interesting stock, growth story. Looks to me like it's in a nice run and breaking out. When I look through my review, Ubiquity had a big breakout, Bible gap up on Friday, closed much towards the lower part of the Bible gap up day, but did close above the 50. I like its earnings per share growth. If this stock was to open up on Monday and the market was strong, I bet the stock goes up. This might be one to take a look at. They had some great earnings come out. All right, what other industries do we have? Third one down was pharmaceuticals. J&J and Merck, big stodgy companies. BMS has some new cancer drugs. They all have some new cancer drugs that are exciting. The ones that have been exciting have been the next couple. And I'll just look at my favorites. These aren't any new stories. Jazz, great earnings per share growth. This is an aberration. When you look out a couple of years, it grows at about 40 times, 40% a year. Predominantly green here, the Bongo Daily red with the pullback. That'll flip if the market trades up Monday and Tuesday. DI crossover, mobile breakout from a squeeze and a kahuna. This has been a great performer. It's getting a little looser here than it was. It's had a long run. I think it continues to run. Probably not a takeout candidate as much as it's actually trying to build itself into being a real pharma company. And there's nothing wrong with that in my book. All right, that's Jazz. I love Activist. You all know that. Maybe it's giving you a buyout opportunity. It's breaking out in a volatility squeeze, mostly green. The red Bongo Daily means it's pulled back. The green weekly means it's in an uptrend. The forces went green. We had a kahuna on Friday, not a cheap stock. Looks like a good one to me. And then probably one of my favorite winners is Valiant. And you can see Valiant continues to have great earnings per share growth. Like Jazz went sideways, you can see a volatility squeeze setting up on the bond and the Bollinger Bands, and the moving edges come together, and a mobile breakout on Friday. Again, everything had pulled back, so lots of Bongo Daily being red, but certainly it's been a very powerful stock and a nice uptrend. The other one I like, which is I don't think it's too late, and I own some of this, at a Bible gap up on earnings, Planet LCI. Look at the earnings per share growth. This is problematic because if they miss, those are high expectations. But when they beat, you get a pretty massive Bible gap up day, and that's what we saw on Planet on Friday. Still like this one a lot. We've talked about that on these calls several times. It's kind of interesting to me that the same old players are over and over again. You try and pick it up, semiconductors, might look at the first two. Micron has been a leader. In the out years on MarketSmith, it's going to have some earnings per share slowing down. However, it looks to me like it's breaking out again here. Great earnings per share growth in the short term. Everything is green. Kahuna on Thursday, mobile breakout on Wednesday from the squeeze. Still looks viable here. It's had a long run though. NXP Semiconductors broke out on great earnings on Thursday or Friday with the kahuna earnings Thursday. Everything's green. Looks to me like it wants to go higher. Beautiful chart. Great earnings story. Couple comments on solar stocks. First Solar is down at the 200. I mean, clearly, if solar is continuing to do well, the whole group will go up. And this is probably a relatively low-risk buy point to get us one of the leaders in the group off the 200-day moving average. The big winner of the year for stocks was Canadian Solar. And there's something about both CSIQ and Jinx, and what that is they got huge earnings coming into their stock. So you got turnaround, massive earning plays, revenues looking strong. Here's Canadian Solar pulled back to the 50. Looks like it wants to run again. And Jinx Solar doesn't look as pretty because it's below the 50, but it too has some massive earnings per share coming into a stock. These are small market cap stocks. Maybe we'll see some M&A in this sector, but I think solar looks interesting in these semiconductors if this market holds up. If the market trades down, all bets are off on everything I'm talking about. Internet retailers, there's a lot of great stocks on this list. We'll look at a couple. Facebook continues to push higher. Everything is green. I continue to think this is an important holding for you to have. Netflix breaking out to all-time highs and still great earnings per share growth. When will this stop down, slow down? It'll slow down eventually, and I don't want to be the last one owning it. But boy, what a big run on this stock. Maybe you're going to see a high volume sell-off one week. This was low volume sell-offs. But continue to want to be long Netflix. I know my buddy George did some short-term trading on it this week and did very well. Priceline going sideways, pulled back, big move on Friday with a DI crossover, starting to turn green on momentum indicators, and a mobile breakout with a pocket pivot and a kahuna. A lot of strength and momentum coming into Priceline. There's a lot. This is different than the last couple of weeks where I've not seen so many great stocks. We'll look at two here. I'm going to look at Google. I'll go three. We'll look at TripAdvisor as well, and then why. Google has seasonal weakness this time of year, and it's probably come and gone. A lot of upgrades coming in on Google. Earnings expansion. Everything is green. Looks like it's breaking out to run again if this market stays healthy. TripAdvisor had earnings come out on Friday with a big earnings move. Trades at a sky-high PE, 55, which looks to me bigger than its earnings per share growth rate, which bothers me. But it's a hot sector, and what a great opportunity down here when it trades to 200 to have gotten interested in it. Bible gap up on Friday. It's an expensive stock, probably not my favorite. YY is a stock that I held, and I got back in when it picked off its 200 again, or got close to its 200. Broke above the 8-day here with the kahuna. Started to turn green above. I like this one a lot. It does have earnings going forward, a Chinese real estate internet play. Hopefully you're getting exposed to some stock names that you don't follow. That would be my mission on doing this. Banking stocks. I own Bank of America. Let's take a look at that one. They've had a big run, pull back to the 50. A lot of green coming in here, earnings per share coming into the stock. All of them will look the same. They peaked in the middle of January, pulled back. Looks like they've stabilized. Perhaps they want to go higher. Citigroup pulled back a lot harder. I don't like this one. It's below the 200-day moving average, which is why I skipped it. And JP Morgan, similar to Bank of America, peaked earlier, pulled back, and moving higher. I still think Bank of America is one of the more attractive ones. Wells Fargo gets a lot of positive analyst calls on TV. Home entertainment software. I wish my kids would home to tell me about the games. I do have an Xbox One. So my wife is around. Here is Activision. Had a big week. I suspect this is an earnings-related story, so I might go long from Web. FinViz. Let it open up here, and it's off screen, but it says Activision at record high after solid earnings. Yeah, I don't know enough about this industry to jump into it. Certainly base for a long time. Kahuna, Bible gap up, certainly could be playable if you like playing Bible gap ups. Electronic Arts. I just don't love their earnings, but charts in a nice uptrend, pocket pivots, everything green is above. None of these looked as good as some of the earlier ones. Airlines, again, I'm a little nervous if we start to see oil go up. A lot of people want to be owning American Airlines, even though they'll be a big winner long term. They've certainly, big viable gap up here. This occurred when the Fed said, yes, we'll let you merge. Continue a nice run up, everything is green. My only issue with American Airlines is I guarantee you as a frequent flyer on multiple airlines, they're going to have major issues when they consolidate their reservation system. Doesn't mean they can't make money. I continue to like Delta as well. Nice earnings per share. Lower left, upper right, pull back with the pullback down to the 50 and running again. Things that look good this week, Southwest also had pulled back like Delta, broke above at 17. Level breakout in the squeeze on Friday, great earnings per share short term. And Spirit was another one that had pulled back, perhaps a little bit too much of a pullback below the 50. So interest in the airlines exist. Then drug retailers, these would be ones that I would think would win in Obamacare. More people with insurance, more people buying drugs, more traffic in their retail stores. Walgreens is an interesting story as they have own a piece of a distributor of AmerisourceBergen, trying to integrate more of the channel. Stock chart is not that exciting. It's kind of sideways, although the last couple of days with Kahuna's, a lot of green coming in and perhaps changing it, but to me it's still in a trading range until something else happens. Rite Aid has been showing up a lot. It too is in a trading range, so not that excited by those. That's what I do for top-down review. Let me do a couple things and then I'm going to turn this off and upload it to YouTube. I like to go into all securities. I like to go into sprinters. And I am working with George to create a more broad Jeffrey views and filters and charts so that all the things that I use, you won't have to go finding them. So here's printers one step with bongos, and you can see I've got 45 stocks. One thing you might want to do is just go through these to see if you can find something that looks good. And what do you see on these 45 stocks? Now this is bottoms up because we're just looking at the stocks, not the industries. Everything is green. Almost all the stocks are above an ERG of 240. Accumulation distributions A and B. Bongo dailies everywhere. A few that are Bongo weekly negative, but most of them are in longer-term uptrends. You can see that from sector perspective, healthcare, information technology, consumer discretion are being leaders. If we look at some of the industries, biotech, which we saw already up, life sciences and tools, which are related to pharmaceuticals are up. Aerospace and defense were strong last week as well. You told me about Spartan Corp. So one of the things that I do with this is I will go through. So let me, it's sort of a cheap. I'd have to go back and do some earnings exploration on this. But I would go through here, ranked by raw combo, and I would look here. I'm going to go real quickly through the first 10 of these, and then I'm going to go look at my group inclusion filter on smart groups, and we'll say goodnight. Myriad Genetics up on earnings and an acquisition. Again, mostly sideways, not a great long-term trend. Like the company, I may watch the stock. Here's a long-term trend, Thermo Scientific Fisher. Breaking out to new highs, everything is green, makes money with a kahuna, nice long-term chart. Lattice Semiconductor must have had earnings, so I probably want to go look at this. It had a viable gap up, everything is green, kahuna's 2 days in a row, tons of volume. It looks like a big gap up, and percentage-wise it is, but it makes money. This is still a cheap stock. It might be one I want to take a look at. Headwaters, this is one that Ron picked up. When you look at this thing on a longer-term chart, it's actually a beautiful picture. Sort of a cup and a breakout without a handle here on big volume and a kahuna. So this is one, as I look at this week and said, is it still time? Yeah, I've got a high-type flag setting up here. Everything is green. It's got great earnings per share growth coming into the stock. This is one that I'm going to look at, potentially get in. I want to see it settle down a couple of days after it's been moved. Nordisk, this is a biotech company that's been a big mover. It gaps a lot because it's an ADR. Covance, Icon, Wuxi are all contract research organizations. A lot of the pharmaceutical companies will be outsourcing more and more work to save costs. These companies are doing well because of that outsourcing. Shire is I think a British pharmaceutical company. Lower left, upper right, in a powerful uptrend. Hard for me to know when to buy these stocks. I mean, if I believe a stock continues to go up, buying them on pocket pivots is a nice thing to think about. It's just an extended stock, but it makes money. And then PerkinElmer, I think they do life sciences, tools and analysis. Pull back to the squeeze with the mobile breakout on Friday and a kahuna. Looks like an interesting buy opportunity there. So those sprinter bongos, I went through 8 of them, show a lot of very viable looking stocks. Lastly, one of my favorite things in HGSI is this thing called the group inclusion filter. So open it up here. And what this allows me to do is to see if any stocks are showing up in a lot of these smart groups. And if the smart groups are designed to be the best of the best, if you're showing up in a lot of them, that might be a good thing. So let's go to WebGem 2.9.14, top 10. Let's take my 30 down to 10. Let's go into the smart groups, which are automatically done scans on a nightly basis. Let's pick best criteria, new highs, best Woodward, under 15, demand, herd, growth, HGS 100 leaders, PLEPS, stocks and groups to the upside, strong EPS rank, and turnarounds. Let's hit OK. It's going to ask me if I want to save it. I'll save it as top 30, which I just hit that. If I want an index, no. I'll ask me that in a second. And now it's done. So these are the stocks that come to the top. Jazz, we looked at that. Questcor, a more dangerous pharma. Aspen, Facebook, we looked at. Micron, we looked at. Alexion, we looked at. Quihu is an interesting stock. Biogen, we looked at. Netflix, we looked at. You notice that in my top-down approach hit many of these stocks right off the top. If I go in and I look at the stocks that we found, we call that WebGems, 2.9, top 10. Let's very quickly just go through the top 10, and then I'm going to say goodnight. Number 1, Alexion, we've already looked at. Biotech stock, big gap up on earnings. Took out the low of the gap day, but I think it goes higher. Everything is green. Aspen Technology, I think is one of the IT consulting firms, application software firms, lower left, upper right, green. It's had a great run in the market. Earnings per share growth seems to be slowing, which would bother me, but it's been a big mover. Biogen IDEC, one of my favorite big biotech companies. Leader we looked at already. Facebook, we looked at it already. Jazz is one of my favorite biotechs. You can see it's pulled back, had a kahuna, huge up day on Friday, mostly green up here. It's got about 40% year-over-year growth going forward. I think it's still a very interesting stock and one that I continue to hold long. Keystone Paper, I'm looking for a low-risk entry on a potential nice stock. I like this. KS, I've been profiling it now several times. It's in a very nice, I don't think that's a cup and a handle, but it's certainly been in a nice basing pattern here. And pocket pivots Thursday and Friday, a mobile breakout from the squeeze on Thursday, a kahuna as well. Volume coming in the last 3 days, great earnings per share growth. I think this one moves up into 35 range, and I like this one a lot. Micron, we already talked about. Netflix, we already talked about. Quihu had great earnings, pulled back. It's a high multiple stock, so it's going to be very volatile, P of 128 in times of market turbulence. But it had a little bit of a pullback this week. Everything's green. Had a nice day on Friday. Great earnings per share growth going forward. I may not mind paying a multiple of 128 if it really is growing 200 times a year. something. I like the stock, and this might be one to watch. Questcore, boy, this is one that shorts like to clobber, and their earnings per share growth is historically great. We'll see. It's traded back up. I own some. I always sell calls against it because they have tons of premium. But it's been moving nicely off the 50-day moving average of about a month ago. Shall it pull that? Looks like it wants to go again. And that's it. So I've looked at a lot of stocks. I've looked at the market. I think we are not necessarily out of danger, but we certainly look like we are at a point where we might get a little bit of run up here. Watch for break of the 50. Watch for breakdown. If we fail, you can see the futures right now are basically not open yet, so these are reflecting after hours trading on Friday, which is pretty flat. So have a great week. Once again, love to see more people come out to PV. If you've never been to the Paul Spertus meeting, it's a beautiful location with masters of the market in Ron and Ian. And, you know, let's be honest, Ian's north of 80. His mind has never slowed down one iota since I've known him, which has been for 20 years. He's north of 80. That's all I could say from a body perspective. Every time we get him is a blessing, and we got him at least one more time. So if you haven't seen him, you've missed out on a true master of our generation. Good night, everybody, and see those of you in New York on Friday. Can't wait. Bye.